Hey traders, investors, it's Serge Berger here. What I want to take a look at today is a very high probability pattern that we can use for more sort of the near-term trading patterns with extremely defined, well and clearly defined risk. I get a lot of questions on this pattern because I highlight it in my course, and I do a lot of these kind of trades also for the traders and the real portfolios that I trade. And the pattern really we're talking about is sort of an exhaustion in a 1 day or a daily or weekly exhaustion candle, okay, or exhaustion day. Um, either upside exhaustion, i.e. bulls get exhausted, or on the downside, bears get exhausted. So the current example I can give you is in the Russell 2000, and if you sort of just take a quick step back and understand where the Russell 2000 is in the bigger picture, I still think we are in sort of in the late innings of a cyclical bull market that came, that sort of arose out of the ashes in 2009. But we've seen relative underperformance both on a year-to-date basis in terms of the actual returns in the index. So the Russell 2000 is lagging the Dow as well as the S&P 500, but also in terms of the patterns. The patterns are much more bearish in the Russell 2000, at least so far. So keeping that in mind, we came into yesterday, which yesterday was Tuesday, June 24th, and we're going to focus on this 1 day candle here. So this is Tuesday's candle. And I'm going to just kind of highlight it so you can see it here. So basically what happened is we came into the day and we opened lower, and then on an intraday basis tried to rally. Okay, let me make this even higher, bigger so you can see it. So we really try to rally on an intraday basis, but the bears at some point around the around noon or so started giving up, and the bulls. The bulls gave up and the bears really quickly took over. So from a psychological perspective, what you have here is a failed higher high. Okay, so the bulls literally gave up around the halfway mark of Tuesday's trading session. Now you can also have this on a weekly basis, right? But the point is the bulls couldn't follow through with their plan, which was to push this market higher. The bears didn't just take over, but they took over in a big way. The market closed right at just about at the absolute lows on the day, and so that puts this area up here, the end of the day, as a very clearly defined risk to lean against. What do I mean by leaning against? In this case, for the more active investor and trader, this is a good spot to try a sort of near-term trade against on the short side. Okay, we know as soon as this high gives, or somewhere up here, it doesn't have to be the absolute high, you can even go a little bit further down. If this market manages to push above there, the bearishness of Tuesday's move is completely gone. Okay, nullified. So basically, then the market's back in bullish fashion. The point that the other part of this trade is that this type of move often leads to some sort of follow-through selling over the coming days. So that's the kind of pattern that you can lean against with very defined risk. You automatically know where you'll be proven wrong. There's no emotions involved, and that's really trading. What trading is all about: making sure you manage your risk and you don't use emotions. So if you have a clearly defined stop here, then you're all set. On the downside, give it a 1 or 2 days of follow-through selling. If you get it, then take profits. If you don't, then of course at the very latest you get stopped out. Although you don't have to wait that long, you can just wait for the market to stop going down and get back out. So I hope this makes sense, guys. As always, if you got any questions, you can hit me up on Twitter. My Twitter handle is SteadyTrader. Thanks, and I'll see you in the next video.